What do you do when your multi-million-dollar startup is careening towards bankruptcy, the market is imploding, and even your closest advisors think you're smoking crack? On Bookish Mind, Season '07, Episode '02, we plunge into Ben Horowitz's The Hard Thing About Hard Things to witness the ultimate fight for survival. Welcome to the Deep Dive, your shortcut to being well-informed. Today, we're digging into a really gripping story of entrepreneurial survival. It's all drawn directly from Ben Horowitz's fantastic book, The Hard Thing About Hard Things. So our mission here is to navigate the treacherous waters LoudCloud faced during that brutal dot-com bubble burst. We want to find out how one CEO made these impossible decisions really to find a path to survival when, frankly, so many others just vanished.
Absolutely. And this isn't just, another tech story. It's incredibly raw, very honest. It's about leadership under just extreme duress. It gets into resilience, the brutal realities of entrepreneurship when everything goes catastrophically wrong. You're going to hear about moments of just profound pressure, devastating news, and the really counterintuitive insights that came out when a company was literally fighting for its life. It challenges, I think, almost every conventional idea of what success even looks like in that world.
Okay, let's set the scene. So, late 90s, LoudCloud gets started, co-founded by Ben Horowitz as CEO and Mark Andreessen as chairman. Big names already. They had this incredibly high-profile start. Top-tier investors like Benchmark Capital jumped in. $15 million investment at a pretty hefty $45 million pre-money valuation. Plus, they got another $45 million in debt funding from Morgan Stanley. And get this, no covenants, no payments for 3 years. It was like the peak golden age of easy money.
Right. It really was. But what's striking looking back is how quickly even that kind of massive early success can become a vulnerability. Andy Rachleff from Benchmark, who Ben describes as a brilliant abstract thinker, asked the seemingly innocent question, but in hindsight, really dangerous. He asked Ben, think about how you might run the business if capital were free. Ben Horowitz later compared this to asking, a fat person, what would you do if ice cream had the exact same nutritional value as broccoli?
That's a great analogy.
It is, because it's so appealing, right? But that mindset, it strips away the natural financial constraints that, frankly, force discipline. They force smarter decision-making.
And Ben admits he totally ran with it. LoudCloud's growth, their spending, it became almost euphoric. 7 months in, they booked $10 million in contracts. They were hiring like crazy 30 employees a month, grew to nearly 200 people in just half a year. They even spent $5 million moving into this lavish office they called the Taj. And it was still too small. People were literally working out in the hallways.
Yeah, and that kind of rapid expansion, it highlights that intense feeling of a race against time, the race against competition that drives so many startups in a boom. The idea was always get big, capture the market before anyone else does. But this story really underscores how quickly that kind of unchecked growth, especially when it's fueled by seemingly free money, can turn into an existential threat when the environment changes. It creates this really dangerous dependence on easy money just continuing forever, which, well, it never does.
And change it did. Boy, did it change. This is where the story takes a really dark turn. The bottom just fell out. The dot-com crash hit, and it hit hard. The NASDAQ peaked March 2000, then just plummeted, down 80%. For LoudCloud, which had basically burned through almost all of its $66 million, this was catastrophic. They desperately needed more capital, but suddenly the well was completely dry.
Exactly. Investor sentiment just flipped almost overnight. Dot-coms became dot-bombs. And that raises this critical question, right? How on earth do you raise money for your startup when your entire industry is collapsing around you? When your customers are going bankrupt left and right? That flood of capital just vanished brutally, leaving so many founders completely stranded.
So Ben has to start pitching for money in this, utterly disastrous climate. He pitches to SoftBank Capital, the big Japanese firm. Afterwards, he gets some back-channel feedback from a board member, the legendary Silicon Valley coach, Bill Campbell. And Bill just gives him the raw truth. He says, Ben, well, honestly, they thought you were smoking crack. Ben describes feeling this, like, primal fear, like he was going to die. Nearly 300 employees, almost no cash left. That's a gut punch.
It really is a total gut punch. And this is where Ben said he learned maybe the most important rule of raising money privately. Look for a market of one. Meaning you only need one yes. You might get 30 no's, but you just need that one investor to believe. And despite that awful feedback, despite the fact that most of their potential customers were these collapsing dot-coms, they actually did find investors for a Series C round. somehow. They managed to raise a pretty remarkable $120 million and at an amazing $700 million pre-money valuation, which seems insane looking back.
Incredible resilience there.
Totally. But as Ben quickly found out, this breather, it was very short-lived. Their sales forecast for Q3 2000 was $100 million. The reality, the bookings came in at just $37 million. The dot-com implosion was just far, far worse than even they had predicted.
So fast forward to Q4 2000. LoudCloud was, in Ben's own words, completely unfundable in the private market. They now had 477 employees and just no options left. Mark Andreessen, trying for some dark humor, apparently joked, "You only ever experience two emotions, euphoria and terror." And I find that lack of sleep enhances them both, which probably felt painfully true right then.
Oh, I bet. And what's really strange here, a real anomaly, is that while the private funding market had slammed shut for companies like LoudCloud, the public IPO window, it was still somehow slightly open, mostly for desperate companies, mind you. Private investors were totally cynical by then, but the public markets were maybe only like 80% of the way there.
A weird market inefficiency.
Exactly. A peculiar inefficiency that ironically offered this tiny sliver of hope.
So with literally no other options, Ben has to go to the board and propose they go public. And his presentation was brutally honest. He laid out all the reasons not to IPO. Sales processes weren't solid. The market was tanking. Customers were going bust. They were losing tons of money, operationally unsound. He basically said, "We are not ready to be public."
And this is where Bill Campbell really stepped up, the legendary mentor to Jobs, Bezos, all those guys. Bill had been a public company CEO himself.
Yes.
He had this unique knack for cutting through the polite BS, especially when things were going horribly wrong. That's when you called Bill. So after Ben's incredibly frank presentation, there's this, awkwardly long silence. Then Bill speaks. First he says, "Ben, it's not the money."
Which must have felt confusing for a second.
Totally. Ben felt this brief, weird relief, but then immediately Bill follows up, "It's the Fing money." Just like that. Brutal clarity. That forced the decision. There was simply no other way out.
Wow. Okay, so they decided to go for the IPO. And the lead-up sounds just nightmarish. Their business model was complex, hard for investors to really grasp. They had these gigantic losses, which looked even worse because of stock option accounting rules back then. And the press, absolutely scathing. One outlet said their customer list was quite thin, that they'd lost something like $1 million per employee. Joke they did it by having a bonfire and burning cash.
Yeah, it was savage.
Another just called it the IPO from hell. They finally settled on an offering price of $10 a share, which actually valued the company less than the previous private round. But as Ben said, it was much better than bankruptcy.
True. And then, it wasn't stressful enough. Just before they hit the road for the IPO tour, another bombshell drops. Their finance director discovers that $27.6 million of their cash was actually restricted, tied up in real estate commitments. This left them with barely enough cash for maybe 3 weeks. Just over 3 weeks worth of cash before you go bankrupt. Imagine finding that out right then.
Unbelievable. It raises huge questions about due diligence, right? Both internally and from the banks. How could that be missed?
Under that kind of pressure, things get missed. It's a scary thought.
So, picture the pressure cooker. Right before leaving for this hellish IPO roadshow, Ben calls an all-company meeting. He announces they're going public. Okay? Then, the really painful part, he announces a 2-for-1 reverse stock split. This absolutely infuriated the employees. They'd join thinking they'd get rich off these shares, right? And this move literally cut their fantasy number in half. It was personal. Ben's own mother-in-law apparently asked his wife, Felicia, "Why does everybody hate Ben so much?" Just devastating on a personal level. And the roadshow itself, brutal seems like an understatement. The stock market was crashing daily while they were pitching. Investors looked like they'd come out of torture chambers. One apparently asked him, "Why are you even here? Do you see what's happening?" Ben barely slept for 3 weeks straight.
And amidst all that professional horror, there's this deeply poignant personal moment. 3 days into the tour, Ben gets a call from his father-in-law, John Wiley. John tells Ben that his wife, Felicia, had actually stopped breathing the day before due to a severe allergic reaction, but she was okay now.
Oh my God.
Yeah, and the shocking part, Jace hadn't called Ben right away because he knew Ben was busy and really in trouble at work. You don't want to add to the burden. Ben, obviously reeling, asks Felicia if he should come home immediately, and her response is just incredible sacrifice and support. She says, "No, get the IPO done. There is no tomorrow for you in the company. I'll be fine."
Wow, the weight on his shoulders at that moment, unimaginable. So the IPO finally happens. They end up selling shares at $6, not $10, but it raised $162.5 million, enough to survive for now. But Ben calls it the least celebratory IPO in history. No fancy dinner from the banks, no party, nothing. His finance director, Scott Cooper, nailed the mood on the plane home. He just said, yeah, but we're still fed. They'd survive, yes, but they were far from safe. What a roller coaster. And it wasn't over. First quarter as a public company, Mark Andreessen's dark joke starts looking prophetic. Things are always darkest before they go completely black. Wolf. LiveCloud immediately needed to reset its guidance downwards, which is, a terrible look for a brand new public company.
Definitely. And as they're debating exactly how much to lower the forecast, their controller, Dave Conta, delivers this absolutely legendary piece of advice. He basically says, look, no matter what we say, we're going to get killed by the market. As soon as we reset guidance, we lose all credibility. So we might as well take all the pain right now, because nobody will believe anything positive anyway. And then the killer line, if you were going to eat shit, don't nibble, just own it, all of it now.
Wow, don't nibble. That's memorable.
It is. And it's profound advice for crisis management, right? About managing expectations, rebuilding trust, face the absolute worst, take the hit, and then you can start moving forward.
So they took Dave's advice. Slashed the forecast way down from $75 million to $55 million. This immediately triggered layoffs 15% of the workforce. And then their own IPO banks, Goldman Sachs and Morgan Stanley, dropped research coverage on them. A huge vote of no confidence. The stock just cratered from $6 down to $2.
And then, as if things weren't bad enough, 9/11 happens. They had this massive deal lined up with the British government, like a third of their bookings. It almost got canceled, redirected to the war effort. Somehow, miraculously, they clawed it back. But it just highlighted how incredibly fragile their whole operation still was. Another huge red flag. Their biggest competitor, Exodus, valued at $50 billion just a year before, filed for bankruptcy. They'd lost $800 million.
$50 billion to bankrupt in a year.
Insane. An Exodus exec apparently joked, when we drove off the cliff, we left no skid marks. It just hammered home to Ben, we need a plan B. Urgent.
So Ben's first idea for Plan B was actually to acquire another struggling company, Data Return. But his head of business development, John O'Farrell, gave him some very wise, very blunt advice. He said, basically, look, our business is in trouble, their business is in trouble. Putting them together, that's just double trouble.
Double.
Exactly. And Ben had this realization. Some things are much easier to see in others than in yourself. Looking at Data Return's problems, he suddenly saw LoudCloud's own future reflected back, and he said, it was not pretty. So that forces him to ask a completely different question, a pivotal one. What would I do if we actually went bankrupt?
And that was the breakthrough. The surprising answer that popped into his head was, I'd buy our software, Opsware, out of the bankruptcy proceedings and start a pure software company. Opsware was this really sophisticated software they'd built internally to automate running their cloud services. It was a valuable IP.
Right.
So then came the crucial follow-up question. Okay, is there a way to do that without actually going bankrupt first? That radical shift in thinking was absolutely monumental. It forced him to imagine a completely different future, totally unconstrained by their current failing business model.
This led to something called Project Oxide. It was a top-secret plan to basically spin out Opsware, sell off the services business, and transform LoudCloud into a software company. He kept it super hidden, didn't even tell most of his executive team initially. He told them it was just another product line because he was terrified the existing business would just collapse instantly if people knew. He even had 2 Stanford MBA grads present him with 45 slides, meticulously detailing why this whole idea was quixotic, misguided, and downright stupid.
Wow, 45 slides.
Yeah, and when they finished, Ben's only response was a cold, did I ask for this presentation?
Oh, ouch! But that really shows the wartime CEO emerging, doesn't it? Ben knew he had the full, devastating picture of just how dire things were. No one else did. He couldn't afford to hedge or soften the responsibility. It wasn't about consensus anymore. It was survival or total destruction. The decisions were his and his alone. He was past listening to advice from people who didn't grasp the full stakes.
Right. The burden was entirely on him. Okay, so even though they actually beat their lowered forecast for 2001, they still needed $50 million more to reach cash flow break-even. They planned a PIPE deal, a private investment in public equity. But just before the roadshow for that, disaster strikes again. Their largest customer, Atriex, declares bankruptcy. They owed LoudCloud $25 million. Gone.
Just brutal timing.
Unbelievable. This immediately killed the PIPE deal. LoudCloud was now suddenly $75 million short of break-even. Ben said they were simply doomed. This forced the secret Oxide plan into high gear. There's no other choice.
And again, this highlights the absolutely critical role of John O'Farrell, the business development guy. Ben called him the greatest big deal person, comparing him to the guy you'd want negotiating your fate with your maker. High praise. He and Ben started mapping out potential buyers for the actual cloud services business. They focused on the big players: IBM, Cable and Wireless, and EDS. Ben strategically figured that EDS probably needed Loud Cloud's capabilities more than IBM did. And in deal-making, as he says, needs always trump once.
Smart strategic thinking there. So, to push this incredibly high-stakes deal forward, Ben and John actually went and got advice from Michael Ovitz, the legendary Hollywood power broker who was also on Loud Cloud's board.
All right, Ovitz. And his advice on deal-making was apparently very direct, very memorable. He told them, "Gentlemen, I've developed a methodology, a philosophy, if you will. Within that philosophy, I have certain beliefs. I believe in artificial deadlines. I believe in playing one against the other. I believe in doing everything and anything short of illegal or immoral to get the damn deal done."
Wow. Straight out of Hollywood, all right? Ruthless, but maybe effective.
Exactly.
Yeah.
A ruthless playbook for when the stakes are existential.
So Ben and John put the Ovitz playbook into action. They set this aggressive 8-week deadline for both IBM and EDS to make an offer for the services business. They hosted both companies, sometimes apparently orchestrating it so their teams would literally pass each other in the hallways, creating that sense of urgency and competition.
Classic Ovitz move, playing them off each other.
Totally. And it worked. After 7 intense weeks, EDS agreed. They would buy the Loud Cloud services business for $63.5 million in cash, and critically, they'd assume all its liabilities. Loud Cloud, the company, would survive. It would retain the Opsware intellectual property, become purely a software company, and EDS would even become its first big customer, licensing Opsware for $20 million a year. It was an incredible turnaround, a total rebirth.
The relief Ben must have felt. He described feeling 150 pounds lighter, just immense pressure lifted. But then immediately, a new, incredibly difficult challenge. He had to tell 150 employees they were now working for EDS and lay off another 140 completely. And Bill Campbell delivered one last, absolutely crucial piece of advice for handling this incredibly painful transition. He told Ben, "Don't go to New York for the big press announcement, stay home." Campbell said, "You need to stay home and make sure everybody knows where they stand. You can't wait a day. In fact, you can't wait a minute. They need to know whether they are working for you, EDS, or looking for a FING job."
Wow. Again, just brutal honesty, but focused on the people.
Exactly. Treat people with respect, even in the absolute worst moments.
And Ben says that small piece of advice, stay home, tell people immediately, was actually the foundation we needed to rebuild the company. Because treating the people who were leaving fairly and directly built incredible trust with the ones who were staying. It was a profound lesson in empathetic leadership, but one he admits he only learned through those awful, horrible, devastating circumstances.
What an absolutely extraordinary journey. I mean, from that meteoric rise to the brink of utter collapse, and then this incredible, totally counterintuitive pivot to survive. Ben Horowitz's story in The Hard Thing About Hard Things is just, it's a masterclass in resilience, isn't it? And making those gut-wrenching decisions when the stakes are literally everything. It really is. And I think it demonstrates that true leadership, especially in a deep crisis, often means making choices that feel completely counterintuitive. Choices that are deeply unpopular, even when it means sacrificing the original dream, the original vision, and enduring a lot of personal scorn along the way. It's really about being willing to, as Dave Conte said, eat shit and not nibble, to face that brutal reality head on, make the tough calls needed for long-term survival, no matter the personal cost or how bad it looks in the moment.
Absolutely. We really hope this deep dive gave you some profound insights into what it truly takes to survive when the odds feel impossibly stacked against you.
And maybe it leaves us with an important question for you, the listener, to think about. What happens when the only path to survival requires you to make choices that contradict maybe every instinct you have about building a company? Choices that perhaps even betray the expectations of everyone who believed in your original vision. How do you navigate that?
Something to definitely ponder. Thank you for joining us for this deep dive.